Alright, folks. Got the recorder going and everything. Volumes have subsided, so this is a good time to talk about this as we roll into nearly the 11 o'clock hour here in Chicago. Okay, I want to talk to you guys about the EA because when we were going through the signal live, I was more concerned with getting the signal out than messing around with recording and everything like that. But now that things are subsided, I think we should have a discussion because it's important that we understand rationale for why we entered and what our risks are, what our potential rewards are, and how we shouldn't skew those to make ourselves feel good. Okay, so EA was based on a number of things. We have obvious, and this is a 1 year, 1 day, 1 year, 1 day chart. You can see that we have significant volume. That's what this teal histogram is. Okay, so you have volume support, and then also this yellow line and this yellow line. That is the what's called the, you'll hear us call it the VA, which means the value area. That means that 70% of the trade over the time of the chart. So for the last year, 70% of the trade has been in this area. So we have support. You can see how over the last, we found support here, almost support here, almost support here, and then almost support here. We're not talking a big, a big change here. And so we have volume support and we have value area support. Also, today the market was down, especially when we got in. It was down a lot more than it was. Yet we have EA up at the time probably about 2%. So in a declining market, you have a stock that is performing well, and you have a technical reason that's lending you support. That was the reason for getting into that. So that's the entry reason. Now it becomes a question of, okay, great, we decided that we want to get long. What the heck do we do? So what we want to do is we want to look at first the standard deviation calculator, and this is so we were trading at the time. We were trading a little bit. Well, we started looking at this. We got in at what, 96. Hang on, let me get these. 96.33 is when we got in. So down at 96.33, we started looking at it right around here. But at 96.33, we decided to go out to April to give ourselves some time. And then the implied volatility at the time was 37.3. Now it is 38. So basically, the same. Actually, vol, interestingly, has gone up on a move to the upside. That's not typical. We'll take it because we're long vol. But we can see that, okay, given that we would be targeting the, if we get the full standard deviation. Remember, we started looking at this when it was about 70 cents higher. We could target 108.5. Okay, so now we have to go out and do the strikes make sense. Well, it's a little bit problematic in that we only have $5 wide strikes, and the 05 and 10 we're kind of in the middle of that. Well, if we go out here and we do the 105 110 call spread, and we got into, when we started looking at, we were looking at getting it in for $1, which means that we could make $5 on our spread. We would lose $1. Not lose, we would spend $1 to get into this opportunity. So the net between the two, we could make $4. So that's a pretty easy reward to risk. Max reward $4, max risk $1, 4 to 1. But that's if we max out this spread, and we already showed that maxing out the spread, you're asking for a bigger move than a 1 standard deviation move, and that's not really, not that that can't happen, but if you want to be pragmatic about things and what is reasonable, because we don't trade in the world of possibilities, we trade in the world of probabilities. Is it possible that this thing goes to $250? Yes. Is it possible that it goes down to 0? Yes. Are either of those outcomes probable? No. So that's why we do this calculation of figuring out what the standard deviation and the price distribution is. So then if you're going to do that, well then you have to base your maximum return to risk on that. Yes, we can max the spread out at 110, but really going to 108.5 is probably more. It's not probably. Oh yeah, it is probably. Statistically, probably more of a reasonable place to target. But we also got in for a dime cheaper. Well, if we only get to 108.5, we can make 350 on our spread because we have the $5 calls, the 105 calls. I'll be 350 in the money, and the 110 calls will be worthless. We pay 90 cents to get in. 260 divided by 90 is just shy of 3 to 1. That's perfectly valid. So now we're being reasonable with ourselves. We're not saying, now, yes, it would be fantastic if we do max out this. And, is it that crazy that we could get to 110? No, because these prior highs were 110.40. Or that's what the 200-day moving average is. These are top of the channel is, excuse me, let me get off to the side here. Top of the channel, is price channel is 108.80. 200-day moving average is 110. So we're being reasonable with what our reward to risk is, and that's what's important. That it's not what is possible, it's what is probable. And you have to be honest with yourself. I can make this look as good or as bad as I want to. Well, if I want to make it look better, I'll just pay, I'm just going to pay 50 cents for this. Well, that's great, Mike, if you pay 50 cents for this, because then you get 9 to 1. The thing is that it's trading 90. That's not being reasonable with yourself. Figuring out what your risk is or what your possible reward is. Your possible reward is 110. Your probable reward, if all things work out, is targeting 108.5. And 108.5 and paying 90 cents for this thing, 2.89 to 1, that's still a pretty darn good reward to risk. Okay, any questions on that? Being honest with yourself with your risk. Being honest with yourself with your reward. Usually it's pretty easy to be honest with yourself with your risk because in a case of a debit spread, it's whatever you paid for it. Being honest with yourself what the reward is, that's where you have to take the analysis into consideration. Okay, any questions on that? Okay, if not, this was recorded. I will get this out to you guys, and then we can move on from there. All right, I appreciate it, guys. Good work on the entry. Right now, this thing is trading. It's 91 bid at 105, so it's trading right around $1. Because, we've rallied nearly $1 since we got into this spread, which is fantastic. And some of you guys even got in at 89 cents. So nice squeeze there. All right. I'm going to get this video out to you guys. Any questions, always feel free to throw it out there.